So for this video, I wanted to show you an example of the way we can analyze a company with all the 9 questions in the same breath, because we have brushed upon all the questions with all the companies, but now I will take it another way, and I'm giving you like a PDF that you can download on this just here on the website, and I will show you what I've done, my work. On the top of the form, just simply write the name of the stock we are studying, ticker symbol, and the date. Today is February 1st, 2018. And we ask the 9 questions with that company in mind. First question, of course, is it a consumer monopoly? So, as we have discussed before, does that company have a moat around its profits? So we can think that the Royal Bank has some kind of a moat because they are just the big 5 big banks in Canada, and they are often referred to as an oligopoly, not a monopoly, but an oligopoly. The financial market being controlled just by the big 5. It is what is said, but we can go and check it out, verified. That's what we will do. So again, on my preferred site, Morningstar.ca, we check out the Royal Bank, and we go into the key stats. I was pleased to see that they have the 10 years are there. They were not there in other places, but in this place, particularly in the key stats, they have the 10 years. What a relief, because now we can see really. So without further ado, so we see the bank's revenue, top line in 2008, it went from $21 billion to 40. That's okay. The margin, that is where my eye is looking. So the percentage, because when you are into a very competitive market, your margin tends to be very slim, dicey, and difficult to maintain. Look at the margin of the bank: 27%, 29, 30, 32, 32, 34, 35, 34, 36. So we can say with a certain assurance that the bank is not a monopoly, but it has healthy margin. It can price things as it wishes. And so, yes, it has a kind of a consumer monopoly. And on the same token, we can answer the second question about the earning per share. Remember, the earning per share, though we remember that the $3.38, $2.57, $2.46, $4.19, $5.49, $6.6, $7.56. So they are strong, they are going upward, and they are there without any question in the last 10 years. So the second question can be answered. So the first, we say yes, of course, and I would say it's a 9 out of 10, if not a 10. The second is a yes, no, nothing complicated yet there, and I would give it a 9 out of 10. Very strong, very, very good. Is it conservatively financed, which we'll see. So I just extract that line from the PowerPoint. So it has $9.7 billion of long-term liability on $71 billion of shareholder equity. So 14 cents in the dollar of debt to a shareholders ratio. It is very conservatively financed. Nothing to worry about there. And if you want to confirm that, very good, you can go into the balance sheet, or simply you go down the first page on the stock price, and you can see here the debt to equity ratio already calculated for you, and it is at 0.1. So there you are. 0.14 is 0.1 when you round it up to the first number. Our next question on our sheet is does it have a high rate of return on shareholders' equity? That should be pretty straightforward to remember how much they love shareholders' return, the return on equity. Remember that ratio 18, 19, 18, 16. And I will show you where to go and check those numbers. We have here the return on equity on the stats. You can see here the return on equity, TTM, for the trailing 12 months. So for the last 12 months, the return on equity has been 16.9, so very high. And again, you can go here on the key stats sheet and find the return on equity ratio at the bottom of the page. Now the return on equity is just here. And you can see since 2008, we have 17, 12, 14, 12, 19, 19, 18. So we have a couple of difficult years after the big recession. But then after that, we just went back to business as usual. So again, this question can be answered. Is that a high return on equity? Answer is yes. We'll give it an 8 out of 10. Does it get to retain its earning? Of course, the bank does not have to spend much money on its operation. We'll go and see that. How much does it spend? We will see that again in the same token. And is the company free to reinvest its return earning? All those three questions tie very much again with each other. We'll see that. So here you have on the key stats, the operating cash and the capital spending here. You have a $1 billion out of $6 billion in operating income. And in 2017, you have $1.3 billion out of $11 billion. So that's 10%. So it's very small compared to how big the bank is. It's a very small amount of capital. They have to spend some capital to maintain the operation, the computers and all the internet stuff, the application they built, and some of the building has to be refurbished and stuff like that. But they don't have to build big chains of to create cars, if you will, or to create trains or planes and stuff like that. So it is there, but it's a smidge if you compare to the earnings of $11 billion. So the capital spending is not that much. On another note, but still important, the free cash flow per share. That's a very nice thing that they calculate here. So you know that because you can have I would say paper revenue, but the cash flow is the real hard cash that goes into the bank, and you take away all the things that don't matter for the cash, and they calculate it per share. And here you have a free cash flow of $27 per share. That's pretty high considering that the shares is trading right now at $100. So it's just 4 times the free cash flow. That's a good ratio if you compare to this. In 2013, it was much tougher at 0.96, and in 2012, it was a negative cash flow of $2. Oh, sorry, yeah, free cash flow exactly of minus $2 per share. So right now we have a very, very good situation on that note. Now the funny one, the number 8, is the company free to adjust prices to inflation? Guess what? Banks can do that. So the fees in the banks, the interest rates, and all the things, the fee they charge, they don't have any pressure with the inflation. And you have seen with the margin and the profit. So yes, the company can readjust easily, and I can give them a 10 out of 10. It's not a problem. And then last question is, are the retained earning increase in the share, are they reflected in the market value of the company? We'll go and see that on the next slide. So I had done that calculation for CIBC in the course, but now we are concentrating ourselves on the Royal Bank. So the earning per share from 2007 to 2017 were $56 total. Okay. If you take away the dividends at $27, so we have retained earnings in the share of $28. Meanwhile, the stock was around $50 in 2007. Now it's trading around $100. That's a value up in the value of $51. So yes, we can say that the retained earning in the stock are reflected almost double in the stock price. So the market has recognized that and is giving even a boost on the bank for those retained earnings. So it's not a problem. So as you can see, the actual price, I'll go back again. The actual price is around 104 at the moment of recording. So you know exactly the date I record that. 104.52. The PE ratio is exactly at this time. The price earning trading 12 months is 13 13.9. The industry average here is 13. So you see that the industry is all the banks and maybe some power corporation and some mutual fund or insurance companies, but it is trading a little bit over the industry average, which is, I would say, a good sign. It's a sign of quality. People are willing to pay a little bit more for Royal Bank than other financial because they have a stronger belief in that earning and their capacity to weather the financial storm that can come ahead. So it is priced a little bit higher. So it's not a bargain, but it's not that expensive. If you compare to the rest of the market, where we are at this point in time, at 13.9, we are in the good average of 13.9. We take that into account. And the question is that a potential buy? From a perspective of a Buffettier, for the perspective of a value investor, that's why I took the Royal Bank. It's the poster child for somebody who thinks more like Warren Buffett. He has Wells Fargo in the United States, and it's not the same, but it's a big, huge bank with a well-established reputation. So, and I think the reputation of Royal Bank is better, I will say, than the one at Wells Fargo, where they have some scandals and stuff. So for that record, I don't encourage you to buy or not. I'm telling you, but from the perspective of the moat, of the earning, of the return, of the retained earning, of the capital spend, of the P ratio and all that stuff, even if it's not a bargain as it once was, and with the dividends and the consistency, it is a blue chip stock, and we can say it is a Warren Buffett stock. So for Royal Bank, here it is.